going to be talking about something that people that understand options very well may feel it's something that they already know, but we're going to be adding a dynamic to it, and that is covered call writing. Covered call writing based on from beginner to expert how to do it. We're also going to be touching on selling options that you should not sell, or at least be aware of the risk of selling them, and why there are scammers out there giving ideas why they are, like selling naked puts and stuff like that. The second half of the show, if we have the time, depending on the questions that come in about covered call writing, which Tom is just this is an equity market thing, so this is something that Tom's going to run with really well. The second half, we're going to talk about, hopefully, if I can make it accessible for everyone, a higher, more complex concept than options, but we will try and put it in human terms, and that's about an EOO arbitrage I did. But to do it, you have to understand the basics of options and early exercise and deltas and the definition of deltas and all the stuff that Tom and I have been talking about. So we're ready to go. I'm ready if you are, Tom.
Okay, yeah, great. Thanks, Vince. I think, Vince, let's just start out. Let's just reiterate we spent, I guess, 3 classes last week speaking about the 3, I guess, most essential Greeks, Delta, Gamma, and Theta.
Right.
We're just going to reiterate now. We're going to spend 5 minutes on it because we're going to assume that you understand this now. And if you don't, just hit in the freaking chat and we'll go over it again.
I'll roll through Delta.
Go ahead.
There are 3 definitions of Delta. I'm not saying that to confuse you, but to reiterate, all these 3 definitions are not necessarily the same, but we're going to tell you which definition we're focusing on for this. Delta can mean the percentage chance or probability that an option will expire in the money. So a 50 Delta option at that moment in time has a 50-50 chance. Definition number 2 is the correlation that an option moves with the underlying to which it's tied. So if IBM's up $1, a 50 Delta call should be up 50 cents. So that's not always true, but that's a definition. The third definition is hedge ratio, and that would be completely unimportant for what we're discussing here. Hedge ratio means if you don't want to have directional opinion and you buy IBM 100 shares of which, I know it's odd lots and big lots, but if you were to buy something 100 times, you would be long 100 deltas, and you want to get rid of 100 deltas or 50 deltas, let's say. So you want to get rid of 50 deltas, you would sell a 50 delta call so that you would be agnostic directionally. But that's not what we're talking about today. We're talking about the definition of delta as probability it goes in the money and correlation with the underlying, but primarily probability it goes in the money. And delta selection is important in what Tom's going to talk about. Second thing is gamma, which is a change in delta due to movement in the market, which is not going to be that important today. But a 50 delta option, if the market rallies, it moves 50 points, and then its delta changes to say 52 because it has a higher probability of finishing in the money. So its correlation changes. The third thing is theta, and theta is going to be your friend in this conversation because theta, or erosion or decay, or an option going to 0 that's out of the money in value, is going to be your friend. We're going to be creating income. We're going to be lowering cost basis. And this is something that investors use a lot of. We'll talk about the pros and cons of it, as well as the beginning, middle, and high level understanding of it, which Tom's going to go through with us. And what we would like you to do, anyone, actually, I'm calling you out. Abel, do you trade stocks? Type faster. Abel, there will be abuse. I'm just kidding. Somebody put a stock on there so Tom can work with. Otherwise, he's going to pick. Yes. Abel, give me a stock that you're interested in or own. We have cameras watching you. Google. G-O-O-G, not G-O-G-L, Tom. It's a 4-letter stock. Are you okay with that?
This is difficult for me. My God.
Oh, is it really?
No, I just
okay. All right, so we're going to use Google. Does that work?
Yeah, it works for me. I don't care. I'm cool.
All
right.
So let's get into it.
All right. This is Abel's question, I'm assuming.
Well,
Yes.
so we're using Google as an example for you to just run with covered call writing and what it means and all that.
Yeah, that's cool. All right. So, I mean, Google's. Let's look at one thing. I'll put something up right here. I'll look at the. I mean, the way I would approach it is this. Like, I don't really. I mean, I follow Google like everybody else follows. I'm aware of it. It's on my screen. I've never really traded it, but that's okay. It's not a big deal for me. I would look in here. I think the stock looks like it had somewhat of a double bottom, tested an old low from back in March. This is about the one. What was that? Did it trade below 1,000? What do I see here? Is that right? Yeah, about 996. Okay, I'm looking at 996. Maybe this top is 1275 level, so that's what 279 points. About 140 points off of this would be 1136, kind of where we're at.
For this example, Abel.
Yeah, I would look at. Yeah, so I mean, I would look at
long-term holding for him.
So long-term.
He's holding it for another 5 years, let's say.
Okay. Here now, if you can see I have the wrong screen up here. What I'll do is you're holding. You are a big believer in the stock. Do you have any type of Abel? Are you able to provide me with a target you've got in the stock?
Yeah.
Say out 6 months or 3 months or whatever.
What price? Yeah, exactly. Abel, at what price would you be? Okay, that's good. Looking to roll regularly.
That's good.
Fine. Okay,
yeah, that's good.
At what price? But hold on, Abel. So you're looking to roll a short call position. That's going to be perfect to what Tom wants to talk about. But at what price would you be happy to sell the stock? It could be infinity. I don't care. Just whatever the price is. Is it, over the next 5 years? What price would you be happy to sell the stock? And obviously not factoring in all the other things that go on in your life. What price, Abel? All right, so maybe he winked out. 1,200. Okay, there you go. He'd be happy to sell it at 1,200. Good luck, Tom.
Well, hey, you know what? Who knows? It wasn't that long ago. It was 1,200, right? October.
I know. But he's also said he's looking to roll regularly, so this is going to play into your whole short.
All right. So my strategy would be this. Like, obviously, here you see what I'm highlighting down here. This is a chart of Google. And this is a chart of 30-day implied volatility in Google. Obviously, this is where the volatility, for I guess reasons that should be apparent to anyone on in this school right now, should realize that volatility is going to hit its apex when the stock kind of hits its nadir, because that's when fear comes out, and fear drives price. So, and puts are, like we discussed before, a little axiom I've come up with. Actually, no, I didn't come up with it. Somebody else did. Calls are a function of greed. Puts are a function of need. So here it spikes, volatility trading close to 40-ish, I guess. That that coincide with the 1,000 low in the stock. Now we've come in a little bit down about 24-ish, I think, in 30-day stuff, which would represent somewhat of a midpoint between this July 25 low in vol and this 1020, whatever the hell this is, 1024 high in vol. Okay. My orders pop up here. Okay, so I would look at it this way. Obviously, hindsight being 2020, because it always is. This would be the greatest time to do it. But let's look at it. Here's what we did. We're at a midpoint in vol. We've got seasonality here in terms of perhaps the market rallying, and indeed it has, quite substantially from last Monday or Tuesday. And we've got the holidays, so you got to be aware of that. And I think that volatility should contract over these next 2 weeks. So I would say I would look at something like this. Let's go out to December. I'm sorry. Let's go. We got an earnings cycle coming out in Jan, I believe. That when Google earnings come out. I think it's covered by this cycle. I just want to make sure so I don't give you anything. I don't give you bad advice here. Google earnings are 25 Jan. Okay, so they're covered in the Feb cycle. So we're roughly here. Where are we right now? 1092. I see. Is that correct? I would do something like this. I would just let's be systematic about it. let's be systematic about it with our approach and kind of, and I guess somewhat disciplined and adherent to a 5%. We're going to just roll 5% out of the money options. So, I mean, if you don't mind selling the earnings month, and you are getting paid, maybe about a click and a half over where you get where you can sell Jan. You sell Jan. I won't screw you up. Sell Jan. I would sell the Jan. I want to go 5% out. That puts me at about 5% is about, what's that, about 55? So roughly the 1150s, we'll call it. I would sell the Jan, regular weight Jan, 1150 calls. Let me just change the screen so you can see what I'm looking at. Right here. You see that? They're about 16 bucks. Okay. It's about 23 vol. It's fair. I mean, in terms of, it's right. If I look at it, I got a thing that tells me where the median vol's been. I'll show you this here so you can see what I'm looking at. Here, this screen here will break down where volatility, where Google vol has been. Right now, it's currently presenting at about a 25. The 52-week median has been about 23, and that's kind of what you're selling. But you're not selling a 50 delta option. You're selling a 29 delta option. So you're selling a little bit over fair value in the stock, and you have fair value in terms of volatility, and you have the additional tailwinds of seasonality, perhaps, and the fact that volatility generally contracts during the holiday season. So I would be a seller of these. You sell them on a rally, right? 17 bucks, 16 and a half, wherever you want to do it, and that gives you about what's that, about 1.7% over the next 45 days. Look at that, 45 days exactly over the next 45 days. So that would be a decent trade. I would do that, and as I got closer, I want to roll these things. Don't wait till a week ahead, 2 weeks ahead. You start to roll. You could roll the same strike if the stock rallies. Stock rallies to 1120. I mean, it was there yesterday, I guess, right?
What
Stock
delta is the option that you sold? What's the delta?
29 delta. 29 delta. If you're long, Google's a big stock. If you're long 500 shares of Google, you sold 5 of those. That's 145 deltas you're selling. So essentially, your delta position would be roughly 355 to be exact. Okay. Now, all you're going to do is you're just taking in some income. Now, this is an income producer. It is not. It will alleviate. It will mitigate some risk, but it is not. It's not something that protects you. All right. It's not something that's going to defray you. It's not something that's going to be this protective in nature.
You can look at it as lowering your cost basis or creating a dividend, but you are not protected on the downside.
Right. You're not protected.
Of the money you've collected.
Period. And look, if this thing trades 900 in the next 3 days, I'll bet dollars to donuts that these calls are trading at the same price, because the volatility will expand that much on such a dramatic move downwards. So
I have a question.
Go ahead.
All right. This is real. This is truly a question that I want to see how this works. If you were to sell that option, how many days are in that option?
45.
Okay. So if you were to sell, let's assume the volatility doesn't change and the stock price doesn't change. Just for this conversation, we can move other variables around. If you were to sell that option today, and every month the market doesn't move, and every month you sell that option, meaning you roll it every month, and it's the same premium every month, you would make X amount of money. What's the difference between that in terms of income and selling? Let's say you did that for 6 months, and selling the 6-month option right now. And I know the 6-month option could be more than one different strike. One could be the same strike, or you could go with the same delta. You know what I mean? So the trade-off from trading the front month option and rolling it every month versus, say, selling a 6-month option, is there a significant difference in that? So one option I think Abel is looking at is selling that 45-day option and rolling it every month. And of course, if the market rallies, he'll sell a higher out of the money option. If the market drops, he'll sell a lower out of the money option. But I'm just curious, if the market were to not move and he were to sell that 45-day option, just take that 45-day option price and multiply it by 6. That's how much money he'd make.
This is the essentially volatility, volatility pricing or option pricing as you go out in time in terms of duration is essentially a case where the sum of the parts is greater than the whole.
Right.
Because you're taking more risk and not availing yourself. You're not availing yourself of that much. What's the word? Cost lowering, cost basis lowering.
Right.
Because you're taking risk on a month-to-month basis. So that's why you've got to get a little bit more. So if you were to do this, conversely, I have the June, you can see my screen. Here are the June 1150s. They're roughly $65.
Okay. So you know what? My question, I'm going to ask you that offline because I need to learn more about that. But Abel has a follow-up question I think is totally related to what we're talking about here.
Okay, where are you here?
How far? I can read it because your screen.
Okay, I see it. I got it. I see it. Look.
I'm going to read it out loud so there are people listening who can't see. How far out of the money do you recommend picking levels? What factors should I look at? Which is a great question.
Yeah, that is a great question, Abel. Able to win. You must have a brother named Kane to lose. I'm just kidding. Now, the way I would look at it is, I picked that 5% because I've been hammering home here for the last month or so about how the market has taken on a more random tone lately, and it's prone to gaps. So we're moving, and there's much more embedded risk in being a market participant right now. So that's why I pick out 5%. Now it's also, you're getting a fair price here. So 5% out, roughly 45 days, a little bit more, 6 weeks or so. That's a different thing. So I would look at that. How would I would look at it? If I was a long-term holder? Look, when I see, here's what I'll show you. And this I think is going to be, I don't want to get into this right today, but that's cool. If you can get it.
Give them the factors, and then you can give an example of each factor, based on premium, based on delta, based on volatility. Those type of things. I think he might blend those together for his own decisions.
Sure. Let me see here. Okay. Now, on this screen here, you see that?
I love that picture.
That's good, right? Let me widen it up.
I love that picture. I so want to arbitrage that crowd.
Yeah, me too. I want to get rid of that. Now, here's what you see, right? Obviously, the brown or mauve back from my days trading with Timber Hill.
Oh, you were Timber Hill guy?
I wasn't. I just traded with them, and they would. I traded with them.
It's green. I'm
supposed traded against them.
It's red. I'm supposed to sell it. Shut up, you moron. Meanwhile, they are now interactive brokers.
I'm realizing. So this is a chart of skew in a multi-expiration on a multiple expiration basis. Okay, so the nearer tenor is Jan of 19, and that's that's represented by this.
Could you do one thing for me?
Sure.
Is there a way that you can mark the at the money so he knows which side is out of the money puts and which side's out of the money calls?
Sure. Here we are at the money right here. Okay, this is 1100. You see that? Yeah, that's 1100. These are the at the money straddle. The at the money straddle in January of 2019 is represented over here at 24. It was just up to 24.6. Okay.
Wait, no, I mean on the graph. Can you highlight a dot and say that's the at the money? This way, when you go back to the graph, you can see. You know what I mean? So they could see what side's out of the money puts, what side's out of the money calls. I'm looking at the graph screen. Oh, did you do that already?
Well, I mean, I know what you're saying. You're saying over here on the montage, on the option montage. Is that what you're saying?
Yeah.
Okay, cool. Hold on one sec. I'll take care of that. Everybody got that? Okay, here. So, but here's Jan. So we were looking at the 1150s. These are the 1150s. Look at them. They're rallying as we speak. These are the 1150 calls in Google. These are the calls to the left, puts to the right. Calls to the left, puts to the right. Bid, offer. Bid, offer. Puts, bid, offer. Bid, offer. Okay? Obviously, as you'll notice here, this is the volatility, implied volatility of these things. Now, here we are at 1095, roughly, will be at the money. Okay, everyone sees that? About a 25 vol. Okay, and obviously, there's a gentle skew, that's befitting of it, and if you go up 5%, 1150, vol dips down to 23 and a half. The skew is not unlike what it is typically presented over history, I think, pretty much. Like I said, I don't trade Google. I've never really traded Google. So that was how far I look out. It depends if where I'm getting paid. Now, if I was now here for you, you're going to get paid more if you look over here. Now, remember that this is the number here, 23 and a half Jan. Okay, that's the volatility number, 23 and a half, and roughly $16.50 mid-market. Okay, now let's see what happens if we went out to Feb. Now, with Feb, you're undertaking more risk, more uncertainty because earnings are coming out. And earnings being a somewhat, binary event, you win, you lose. There's a little bit more, there's more risk attached, hence you're going to get paid more to sell that risk or, you sell those upside calls because, the stock could rally, 10% overnight, right? That's possible. Okay, so now these, well, they don't have 1150s, I guess. So the 11, if I made an 1150 call out of here, I'll just keep it simple. We'll just split the difference here. 64.50 be 32 and a quarter. Okay, I'll say they're about 32 and a quarter at about a 26 and a quarter volatility. Notice what you're getting here.
You're a mad scientist,
right? Well, you're getting 26, roughly 26 and roughly 26.40. We'll call it volatility versus 23 and a half. So we're almost 3 clicks better, almost 3 points better in terms of volatility. What you're selling at Feb. And you're getting, what we said this was 32 and a quarter. And the price is almost double, right? The other thing was 16.50. This is 32 and a quarter. So from that standpoint, if you're a holder, that might be the best route to go. You're getting paid there. But realize this, if any type of pre-announcement comes out, and anything in tech world, Apple, Facebook, maybe not Facebook so much anymore, but any of these FANG names or something like that, which they were certainly got their wings clipped lately. If it was deleterious, or indeed if it was good, especially on the downside, if it was bad, this volatility, especially in the earnings month, is going to inflate. So you might have been able to get more, whatever the hell that means. But you got to realize that. But that's one of the vagaries of playing the game. So I look at where am I going to get paid? Like, you know what? You get paid the most out here, out in Feb, but you're undertaking more risk, and that's cool. If you could also, Feb's a long way away. I think the earnings don't come out till January 25th, so you got roughly 50 days, we'll call it, before January earnings. Anything can happen. The stock could rally to 11.25. You could roll up to a different strike in Feb. There's a lot of flexibility here. But what I would look at, I think you're getting a fair price here. I think you have holidays that are going to really knock the wind out of volatility. Between it and the holidays are on a Tuesday, which are kind of bad because you knock out probably Monday's going to be a long weekend, and you're coming into the Friday's usually slow. So I think you're looking at 3-day weeks max. You got to be aware of that. So I think these would be the Jans would be my sale in there. So you got to be cognizant of that. Be aware of look. Here's an great example, Vin. You're probably going to ask me that, but I got lucky. I did these spreads. Here, look at this here. Now, this is this week. We're 10.95. This straddle is $21. Look at the theta in these options. Theta, we know what that is, right, guys? Theoretical amortization. That's a decay. Now, this thing, these 10.95 calls that expire on Friday expire at, their theta, their theoretical amortization. They decay at a rate on a linear basis right now. It's more, it's not, it's a little bit faster than money, but they're going to pay about $1.64 a day. Okay. But now think of what happened over the weekend. Now, this is an extreme example. It doesn't happen, thankfully. But what happened is any of these guys who were long these things into the, coming into this week, they kind of got screwed by the death of by George Bush 41. Because what happens is they lost a day of optionality. And that's in a stock like Google. That's a tough pill to swallow because you lost $1, probably $1.50 in terms of that, in terms of value in these things. So they as soon as that's announced, everybody moves their sheets up. Now, Vince was a market maker, as was I. When I come in on Friday afternoon, last Friday, I'm using sheets from Monday morning or sheets. I'm dating myself. I'm looking at Monday sheets. I always want to look ahead. I always want to look ahead. We always want to look where volatility is going to be. So now when they come in Monday, they would typically look at Tuesday or Wednesday. But now all of a sudden it accelerates because there's a Wednesday off. So that's an example where volatility, losing that day, and I would just correlate that with what's going to happen or what should happen in the holidays. This is absolute. This is the other one is probable. When you lose that day, that's a heavy pill to swallow right there. And there are going to, I would postulate that there are going to be 3-day weeks for all option purposes on the holidays. So I'd be aware of that. And I think the Jans are the better sale. Okay. I hope that answers your question. Does anybody have a follow-up question or we can go different stock? What to do?
I want to boil down what you said in a bullet point thing with regard to the factors that you touched on. Abel, there are several factors that you can that are important, but you'll have to make the decision for yourself. Let's assume that you're going to sell because you talked about rolling. Let's assume every month in Google you're going to sell a 45-day option. That's just, we're not going to move time, as opposed to my question about selling a 6-month option. So the criteria for picking the option you sell can be based on any mix of one of 3 things. We're going to look at the 3 things in isolation. 1, you pick a delta because that delta is what you're comfortable with. So you pick a 30 delta option, and that delta is something you're comfortable with. But usually you don't start with delta if you're a long-term holder of stock. The delta is actually something you figure out later. You go more with premium. How much money can I take in? And then you said, and you find, oh, I can take in X amount of dollars. You say, well, I think that's a nice little dividend to create. But then you have to look at, well, I think Google's going to go to 1,200 before I sell it. And does that premium reward you enough to give away your stock before 1,200? So making something up for you. An ideal example would be picking a stock that when you sell the call, the premium you take in equals 1,200. So I'm going to make it up, right? So let's say it's an 1180 call, right? 1180 call is trading $20. It's not. You sell an 1180 call and you're quite happy because if it goes to 1,200, if it goes to 1180, you'll have the stock called away, but you will have collected $20. So then you've made $1,200. So the first criteria for a long-term holder of a stock in call writing, in my opinion, should be knowing what price you're comfortable selling the stock at. Once you do that, and you said 1,200 for this example, then deciding on do you want to have, and you're going to do a monthly roll. Do you want to take in more premium or have more risk of it being called away? So to keep it simple, I want to take in more premium. I'll sell the 1190 call. I'm worried about it being called away. So I'll sell the 1210 call. So it's basically premium versus potential.
Yeah.
That's that. And what you'll find out once you know your own risk parameters, once you know what you're most comfortable with, you will find out by doing that, by understanding I like this dollar amount and I like this level, the Goldilocks level, you will find out that it will usually correlate 90% of the time with a specific delta. And that's how you find the delta option you want to sell. And using all that, once you know all that, then from time to time, if you're doing it month to month, you'll start to notice things that Tom knows intuitively, like the volatility is high in this delta option that I normally sell. Usually I only get 45. Usually I only get 50 cents for this option, but now I'm getting 90 cents. Maybe I want to sell that option, but maybe I want to go back to 45 cents and sell a higher strike. So once you replicate your strategy over and over again, after determining your sweet spot of premium versus getting the stock called away from you, you will come up with a delta that lines up with that a lot. And once you line that delta up, you will be able to feel, even if you're not a student of volatility the way Tom is, you'll be able to feel, wow, this is pretty high. Considering last month I only collected X amount of dollars for it. How come it's pretty high? And then you'll say, oh, there's earnings. That makes sense. I'm comfortable selling it. Or there's no earnings. That doesn't make sense. I'm comfortable, or maybe I'm not comfortable selling it. Does that help, Abel, in distilling what factors you could look for in determining your own risk reward criteria that Tom said? I'm going to assume yes. I'm going to assume yes, and his fingers are in a cast. John is not able, but he is perfectly capable. Cool, John. Thanks. Yeah. So basically, that's the concept. The concept is if you're an investor or you own a stock for a long period of time, think in terms of money. And once you think in terms of money and a comfort level that you're willing to take in versus price that you're willing to have it called away from you, then you will find magically a delta. And that delta will work for you. And then you will see month to month, whether you're going 1 month or every 6 months, you will see to the extent that the option is worth more than it used to be or worth less than it used to be, you will then make a decision. Oh, well, I'm getting a lot more money for the call this month. I'm gonna piss on it and I'm gonna sell even more than I usually do. That's great. There could be a takeover rumor. The options value gives you an intimate understanding of what's going on. We got a question. If I let Google for years and years higher, but want to sell against it, if I get called away one time and then get back in buying stock, is that for long-term gains? You're talking about capital gains like taxes? Okay. Yes. Okay. As a market maker, we had an 80-20 tax split on capital gains. Tom might know that better than me, but I'm pretty sure I'm pretty sure I don't know for stocks. Tom's got to answer that.
Yeah, that's fine. Look, I think what's important here, and I know you mentioned like the stock never gets called away unless you allow it to get called away.
But let's assume it's not. But is it long or short term capital? Wait, hold on. If you're getting called away on a stock, John, that you've held for X amount of time, it's whatever long term capital gains are. But the income that you're making from selling the options, I don't know if that's long or short term capital gains. Does that make sense? If you get called away one time and then get back in buying stock, is that for long term gains? Yes. If the stock gets called away, you've done a transaction, you sold the stock. That would be long-term capital gains, assuming you held it for 5 years. And when you get back in, you're starting over. So yes.
Right. Yeah. You got to realize, John, you don't get called away unless you allow yourself to get called away. You can always buy the call back and sell something else against it.
Yeah, John is correctly letting us, know that if you've owned a stock for generations, your great grandmother bought Coca-Cola and you're selling calls against it. She grew up in Atlanta and she's got a Pearl cane and Coca-Cola, and it's that long-term capital gains, and boom, you sell it and then you get back in at the same price because you changed your mind. Well, you're going to pay long-term taxes on it, but the next time you sell Coca-Cola, it may not be long-term taxes. So that's a really good point, and that is a risk. That's an added risk.
Right, but in this scenario, I think it's quite similar to Abel's. Is that you want to regularly roll? You're a shareholder for life. I know that's kind of trite, but you don't get called away. You never get called away unless you allow yourself to get called away. Stock trades 11.40. We sell these Jan 11.50s.
Right.
Stock trades 11.40 tomorrow. All right. Now we think the stock's going to 1,200 the next 40 days. We buy these back and we sell the Feb 1200s at $35 or something like that.
Right.
And continue to roll. You never get called away. That's important to understand.
That's actually true. On two levels. One, if you've come to an understanding based on your risk reward parameters that your Goldilocks level is, let's say, a 30 delta option. If it goes in the money while you're short it, you can roll it, or you can roll it diagonally, or which would reduce your income, or you can do cash options, which you wouldn't get called away on if that's possible. But in the next month, if you don't get called away as we go to the next month and the market's higher, you would then just roll to the 30 delta higher. So yeah, that's a good point. You rarely get called away. That's true.
Right. I mean, you don't have to get called away. Just keep rolling, buying them back, and selling something else. Whatever you got to do. You never get called away unless you allow yourself to get called away. That's important to understand.
Right.
You're not going to worry about it. And plus the fact, I mean, this is like the elephant in the room, right? If you sell the Feb 1200 calls here, whatever it is, $16, and Google's trading 1300, maybe you're kind of like, wow, that's further than I ever thought it would go. Well, is that the worst thing in the world? These calls are worth 100, but you participated all the way up to 1,216, whatever the heck it is, from
Right. Right.
that's not the worst case in the world that could have happened. But important to understand. I want to stress this: you never get called away unless you allow yourself to get called away. The market's so fluid, so liquid. Somebody's on the other side of it. Someone's long those things doesn't mind selling them out, or some type of strike, some type of congruent delta at a given point in time. So don't
Right.
worry
And that's
about
the
that.
standard rule in any product. The short is in control. And by that I mean, if I'm long an option and you're short an option and I say I want the stock, you don't have to give me the stock until after expiration. You can cover or you can roll. The short is in control, not the long. So the long can demand it. You can just cover and someone else will get the short. That's basically it. So yeah, that's true.
Right. So realize that you never get called away unless you allow yourself to get called away. It's an important concept. I mean, it's people always talk about this stuff, and because don't worry. First of all, it's not the worst thing in the world. It's a good thing, right? If there's a chance you're getting called away, because obviously the stock price is appreciated so much to your short call strike, which is great. But if you only get called away if you allow it. If you don't allow, if you say no, I still believe in the story. I'm rolling it. You're buying back. You sell something else. On to the next trade. Period. You never get called away unless you allow yourself to get called away. Write that one down. Okay. All right. What else we got here? We did Google. We did, yeah, I'm just trying to think. We talked about about theoretical amortization. What else do you want to talk about, Vince? You want to talk about? Why don't you put up a disclaimer about? I'm a big fan. I'll sell options when I'm getting paid. Period. I've got a inherent long vol bias when I go things, but now. When you're getting paid, but now you have the put seller, the naked put seller out there. Okay. You want to say a few words about that?
Yeah, sure. There's a strategy that's become popular, and it started becoming popular with pension funds about 7 years ago, in a desperation to increase yield. And now retail investors are not only doing it, but being shilled to do it or pitched to do it by disingenuous people. And I'm going to go through that with you now, and why it's appealing and why it's wrong. Doesn't mean there isn't a time to do it. Warren Buffett did it with Goldman, but you have to know what you're getting involved in. So what we're talking about here is naked put selling. And here's the pitch. I'm going to give you the pitch without the risk. Okay. Remember, I'm giving you a sales pitch that you'll hear, and you're not going to hear the risk. Here's the pitch. Google's a great company. You love Google, right? Where's Google trading right now, Tom?
Oh, 1091.
Okay. Wouldn't you love to buy Google at $1,000 or 1050? I would love to buy Google 1050. I mean, if it dips down there, that's a great buy.
I'm a buyer. I'm a good buyer at 1050. Oh yeah,
exactly,
sure.
Right, exactly. Tom's going to be the naive retail client here. He's watching the video of an advertisement that we clicked on by accident. Some clickbait. Okay. Not only can you buy Google at 1050 if it goes there, you can buy it and get paid to buy it. What does that mean? Well, we sell a put, and we sell that put naked. So we take in a lot of money because puts are worth more than calls. If you look at the smiles that Tom puts up there, you see the out of the money puts have higher volatility than out of the money calls. So, but we don't talk about the retail customer. We don't talk about the customer. We just start to sell the snake oil. We say, if you sell the 1050 put, you can take in $30. And if Google doesn't go down, you've made $30. If Google goes up, you've made $30. That's evergreen income. Every month you can do that. You can make a lot of money. And if Google does go down to 1050, you've made $30 and you own Google 1050. And you like the company, right? Yes, I like the company. Okay, so let's do that. And pension funds started this. And I talked about this in an article on volatility when the market blew up. And it was on Zero Hedge at the time. We're talking about how pension funds were writing puts naked to create income. So pension funds have promised, this is where it started. Pension funds have promised retirees 7% per year. And in a desperation, and one of the things they're doing to create alpha would be to start selling naked puts because they're fat in terms of relative to the equidistant out of the money calls. And then they say, we'll just buy stock if it goes down there. Well, that's not picking up pennies in front of steamrollers. That's picking up dollar bills in front of steamrollers. So what ends up happening is uh, uh, you'll make money. People make money doing this. James Cormier did a lot of this as well in a more complex way. So you're selling that 1050 put. You're making $30 3, 4, 5 months in a row. But here's what they don't tell you. There are two ways you get hammered on this. One, the market, the obvious one. The market goes to 1050, and then it goes to 1,000, and then it goes to 950, and you are buying Google at 1050 plus the $20, so your cost basis is lowered to 1030, but you're buying it $80 over where it's trading. Do you still like the company? Why is it trading that? Why is it trading there? Because, censorship, because of something, because the CEO was snorting Ajax in the bathroom. I mean, the blue dots are very powerful, by the way. You can't, you can't, you can't, they're not telling you the risk. The first risk is the most obvious risk. What if it goes below the price I bought? Then you have given up because you're short it. You have given up the option to buy it at 1050 to someone else. That's the most obvious thing. Here's the one that's not so obvious. And here's the one that blew out optionsellers.com. They did it with calls, but we're going to do it with puts here. Google drops to 1070. You've pocketed $20. It's not going in the money. I'm guaranteeing you for the rest of this conversation, Google will not go under 1050. But at 1070, volatility explodes. And that option you sold at $20 should be worth $30 right now because of its delta, but it's actually worth 50 because everyone's panicking buying puts and volatility is going up. And you get a call from your broker or maybe an email from your broker, and he says, you have a margin call and you have to put money up. So not only do you have to put the $20 back that you took out to buy the GI Joe with the Kung Fu grip, you have to put another $100 in there to cover the margin call. You're still not locking in losses. So you have more money tied up and you're sweating this out. And the market doesn't go below, but you've got to sell something. You've got to sell your car to put this money in the account. You have margin call risk. And this is what makes people get killed on these things, especially when volatility explodes. So if you're selling naked options, number one, if you're selling naked options, especially on the put side or in any product where the volatility expands in the direction of the move, in natural gas, volatility in the wintertime will explode as the market rallies. In crude oil, generally speaking, in almost every month, volatility will explode as the market drops, just like in stocks. If you're going to sell naked options because you like a company, then you have to really understand what you're getting involved in. You're going to collect $20, but you may have to cough up another $20. So what's your rate of return? It's different. You're collecting $20, but you may have to buy the stock $100 above, and you don't have that money where the market is. So let's go to Warren Buffett's trade. I don't have the details of it, but it goes like this. Warren Buffett, when he invested in Goldman, saved Goldman, did a deal with Goldman after investing in Goldman where he sold naked puts on the S&P in a strip form. Now, why did he do that? Well, number one, he knew it was going up. We're not going to talk about how much inside information he has, but not to mention he wrote an op-ed goosing the market. But number two, and this is what we can do, all of us as traders, is if you're going to sell a naked put, you have to have the money in liquid so that you can cover a margin call. What would your margin call be? Well, you're creating a dividend. You're not hitting home runs by selling naked puts. You want to, if you're doing that, and I don't recommend it because it's complex. I'm not saying you're not smart. I'm not saying you're not complex, but believe me, when that put goes in the money, your baby will get colic, your car will get a flat tire, and your roof will cave in at the same time, and you will just be distracted. If you're selling a naked put, you have to have hundreds of percentages of that money in cash for covering margin calls. So to that extent, unless you're trading volatility, selling naked puts because you like a company is for brain damaged people. And brain damaged people like brain damage is not necessarily genetic. It can happen from getting hit by a hammer, but brain damaged fund managers sell a put to create income for clients. Remember, James Cormier did not have skin in the game. He was not trading. He was giving advice. Sell a put. And if the market dropped, he would tell people to sell a call. Well, when natural gas rallied, he told people to sell puts, because if you sell puts, then you create income and you lower your margin calls. And in the end, you're left just short everything and you get hammered. So if you're going to sell puts in a way that I think Tom likes to do, is after a market has had a steep drop, like the S&P, for example, you can sell puts naked if you have those kind of intestinal fortitude, testicles, I think, for boys. Or you can do something where you do a back spread or 1x2, where you buy one put and sell two. But this is only after the market has sold off, after volatility has exploded, and you expect a regression to the mean. So selling covered calls, good. Selling naked puts, very risky. I hope that covers it. Any questions about that? Okay, so there will be a test tomorrow. Tom, why don't you give us an example of how you like to play when a market drops? We only have like 5 minutes, but when a market drops, how you like to play selling puts. Again, this is a professional who's looking at his risk reward as well.
Yeah, like I mean, I am a good put seller when I'm getting paid. I'll sell anything when I'm getting paid. I don't care. It doesn't really matter. As long as I'm getting paid to do it, I want to do it. Like I look at today, I think this one I hit up before we got on the screen here. The vol is starting. The earnings. This is Federal Express. This vol is popped because I think they have earnings coming out in. I got the wrong day. October 29th.
Right. That's something to keep in mind when events come out. A lot of times trades are events. If you haven't noticed, when earnings come out, before earnings come out, volatility goes higher, and then he sees as an opportunity to take in some premium, but minimize or mitigate directional risk.
Yeah. You know what? That's cool, because if you're in the chat here, I did a trade on Friday afternoon on the bell. Not on the bell, like 355. You saw it. You can go check it up in the op trade blog. I bought Caterpillar. Put it up. Here's what I did. I look at technicals, and I saw 135 as a resistance point, halfway between 112 and 159. I guess I don't have the chart in front of me. I think that's what the number.
I have the trade. If I can just say it out loud so people can see it. On the 30th, you bought the Jan 120, Dece 125 put spread, paid 121. Is that?
Yeah. Then I paid $1.60. I don't know if I paid $1.16 on a brace below that, but that's fine. Yeah, I paid $1.21, 11 squared. I knew you were going to go there.
This is the diagonal put spread?
Yes. And at the time, probably delta neutral. But why I did that is because the volatility, because I mean, and I'll be totally honest with you, I really wasn't, I kind of knew Trump and Z were going to have dinner or whatever the heck they were going to do. But to me, it doesn't really matter. I mean, as long as I'm getting paid, I don't get it. Everything's in the market. So to me, everything's a function of, do you buy the rumor and sell the news? I mean, you got to run up at the end of the day, blah, 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 blah. Stock's 135, 136, kind of want to sell it there. I don't mind taking a shot. But I said, wow, do I sell the stock? Or let me look at some put spreads. So I was selling a 125 put. Oh man, it was probably 47 vol. I know it's like 46 now, but the price is a lot cheaper. And I was buying Jan 120s, pretty much delta neutral or a slight negative delta, a very slight negative delta because of duration. And I think I sold 46 and paid 38 or something.
So explain this to me. You have December and then 07 in parentheses. Does that mean it goes off December 7th?
Yeah, they expire on Friday.
Okay, good. So it's like a week of options.
Yeah.
Okay.
So I said, okay. I looked at some stuff. I thought maybe the stock gets down on a sharp decline. I can look at a P&L graph and say that, well, where do I have room the next 3 or 4 days? No deal with China, whatever the heck it was. I had room down at 125, doing something like this. I'm fine. I'm very comfortable with that. On a $10 down move, I'll live with it. I got room down at 125. I'm still going to be. I was leaving volatility alone, but I got to realize I'm long Vega because I'm long duration, right? Vega is. We don't want to get into that, but I'm long.
No. Let's get into that in one phrase. You ready? This is good. I can do this. I can help you out with this. He sells the 125 put that expires very soon. He buys the 120 put that expires later on. He's basically long Vega and he's short Gama, which we'll talk more about later. So if the market drops, he's going to lose money more quickly in the 125 put than he will make in the 120 put, normally speaking. But because volatility will expand as we go lower, the 120 put has more Vega, and that will also partially offset his losses on this trade. This is not a back spread or 1x2, but it is an example of selling a short dated option to finance a longer dated option because he thought the short dated option was overpriced going into the earnings. Does that make sense? Is that right? Am I right in characterizing it that way?
That's exactly what I did. I was taking in a lot of volatility skew, and these are concepts we'll go into our next show. I took in a lot of volatility skew, so I'm willing to sell that put. I got $10 a room at the time. I could pay $1.21, knowing that if the market doesn't take off and explode through 140, which it did on Monday morning, but it backed and filled, I guess. I got plenty of room. I got room between 124 and 138 end of week this week, where I make money. So that to me is, and all of a sudden I know the vol is going to come out of this. Once that announcement comes out, well, the binary nature of these options, because they were trading 45 volatility. They were very, very jacked for obvious reasons. Because I mean, here comes a big announcement. Anything can happen, and now we're back maybe $1 lower than where I put this on. I don't know where we closed Friday, give or take, maybe $1 higher here.
We only have 1 minute now, Larry.
Yeah, yes, the spread's $1.50. So I paid $1.21. It's $1.50. I made that's a 25% return. Now, if you see me, what I'm looking to do now is I'm looking to buy these back. All right. Now I'm just trying. These are advanced. If I can handle it, it's not a big deal. And I want to sell these puts. I want to sell the 123s.
Don't do that yet. Please don't do that
right
now.
So I'm rolling. I'm doing what Neil does.
But I have a joke to tell.
Go ahead. Let's hear a joke.
Okay. Tom is Irish and Italian, and I'm Irish and Italian, and so in the PC world, I have to say this. I converted to Judaism some years ago. I married a Jewish woman, ex-wife. My children are being raised Jewish. So, like a Seinfeld episode, I feel that I can say this joke. The anti-dentite episode. 30. What is foreplay for an Italian, Tom?
Oh, just hey, in a Bronx Tale. Hey, Maria, get out of here! Come out of the car.
Please don't do the movie. Just a joke. What's foreplay for an Italian is 20 minutes of arguing.
Yeah, that's true.
For a Jewish person is 20 minutes of begging. Wait, here's the best one. Foreplay for an Irishman.
Go ahead.
Are you ready, honey? Guys, we'll talk about that other option stuff later on, but hopefully this was very helpful on covered call writing because it reminded me of stuff I'd forgotten, and I appreciate Tom really going through this in that way that he does. But tune in again. When do you think our next show is going to be, Tom?
We're going to do Thursday, 1 o'clock. Tomorrow we're off. Thursday, 1 o'clock.
Right. Tomorrow's a holiday. Don't sell options now. It's too late. Have a great day.